Compound interest is the most trusted idea in all of finance. It's also the exact reason most leveraged ETF investors lose money. 2 investors. Same average return, 10% a year for 10 years straight. Investor A gets there slowly and steadily. His money grows about 2.5 times over. Investor B gets the same 10% average by swinging hard, up 70% one year, down 50% the next. 10 years later, he's lost more than half his money. Same average return, opposite outcomes. That gap is what compounding actually is. And right now, real money is sitting inside triple leveraged ETFs, held by people who assume compounding is quietly working in their favor just because they're holding on. If you've ever looked at one of these funds and thought, I'll just buy it and let it compound, this is the warning label nobody hands you. So here's where we're going. 1. Why the most famous idea in personal finance has a dark side nobody teaches. 2. The graveyard, real funds, real billions, erased by this exact math. 3. The one condition that flips compounding back onto your side, the same one this channel is built on. Start with the myth. You've probably heard some version of this line. Compound interest is the 8th wonder of the world. It's usually credited to Einstein. Here's the twist. Nobody has ever found him saying it. It became famous entirely on vibes because the idea underneath it is too seductive to fact-check. And the idea itself isn't wrong. Money that grows on itself year after year is one of the most powerful forces in finance. For a normal, unleveraged portfolio, that part is true. Here's the part we don't say out loud. Compound interest doesn't care which direction it's compounding. It has no opinion about whether you're winning or losing. It just multiplies whatever happened last period by whatever happens this period, forever. No judgment, no favorite, which is exactly what happened to Investor B. Multiply his swings together, 1.7 times 0.5, that's 0.85, meaning across every 2-year cycle, he actually lost ground, even though the simple average of plus 70 and minus 50 is a positive 10%. Run that 5 times over 10 years, and his money falls by more than half. That gap between the average of your returns and the actual return you get is quietly one of the most important numbers in investing. Now watch what happens the moment you put a leverage multiplier directly on top of that gap. Buried inside every leveraged ETF prospectus is one sentence that changes everything. It says the fund targets 3 times the daily return of its index, not 3 times the yearly return. Daily. The fund resets its leverage every single day, which means every single day it's running the exact same up-down math on whatever happened that day. Here's what that math actually looks like. An index goes up 10%, then down 10%. You'd think you're back to even. You're not. You're down 1%. Now put 3 times leverage on it. Up 30%, down 30%. You're not down 3%. You're down 9%. Same round trip, 9 times the damage. Because the machine doesn't just multiply the gains. It multiplies the gap itself. If the market chops sideways for long enough, this quietly eats a fund alive, even while the index itself goes nowhere. That's not a hypothetical. In 2018, the NASDAQ 100 finished the year essentially flat, down 0.13%. Its triple leveraged version over the exact same 12 months, down almost 20%. One number is a rounding error. The other is a disaster for anyone holding it. Professionals call this volatility drag. The name matters less than what it's done to real money. And what it's done to real money is where this gets serious. Sideways markets are the slow bleed. Falling markets are where this becomes a graveyard. 2022. The NASDAQ 100 lost 32.6%. Its triple leveraged version lost 79%. To To recover from a 33% loss, you need a 48% gain. To recover from a 79% loss, you need 378%. Not a comeback, a resurrection. But a drawdown isn't even the worst outcome. Some of these funds don't recover. They disappear. April 2020. Oil did something that had never happened before in recorded history. The futures price went negative. Credit Suisse ran a fund built to triple that price, long. Then it hit zero. Gone. Not down. Gone. 2 years earlier, a different daily reset fund had already shown how fast this can happen. Technically, not a leveraged ETF, but a note tracking the inverse of market volatility, running the exact same engine. Reset daily, multiply whatever happens next. In a single afternoon in February 2018, that fund lost 96% of its value. Almost $2 billion gone by the next morning. The bank shut it down within 2 weeks. It doesn't exist anymore. You cannot buy it today at any price. Almost nobody reads the mechanism until it's already running against them. Quick pause. Every fund you just heard about was missing the same thing, a predetermined exit line. That's exactly why I built a free calculator that forces one onto the page before I ever click buy. It's linked below, completely free. Back to the math, because this story does have a way out. Here's the part almost nobody puts in the same video as the graveyard. The exact same engine can run in the completely opposite direction. 2023. The NASDAQ 100 had one of the strongest years in its history, up about 55%. If daily compounding were purely a tax, the triple leveraged version should have landed near 165%, 3 times that number, no more. It didn't stop there. It returned almost 198%, more than 3.5 times the index's actual gain. Not 3 times. More. In a strong, sustained trend, the identical math that tears a choppy market apart starts compounding gains on top of gains instead of losses on top of losses. Leverage isn't the mistake. Leverage without a trend is, which is the entire reason this channel exists. Everything I trade runs on leveraged ETFs, but never by holding blindly. My rules re-rank every position every month and drop anything that isn't actually trending anymore. And every position I open has an exit line decided before I click buy. The same discipline that was missing from every fund in that graveyard. You've watched me take an exit at a real loss on camera because the rule said to. Compounding doesn't fail on leveraged ETFs. It just refuses to pick a side. Direction is the only thing that decides whether it's building your future or erasing it. So, does that mean leveraged ETFs are safe now? No. This channel's own strategy has taken real losing months. Compounding gets managed here. It never gets eliminated. Most people don't lose money to leveraged ETFs because they're reckless. They lose because they trusted a beautiful idea, compound interest, without ever asking which direction it was pointed. Compound interest isn't magic. Direction is. I stopped buying hope and started following data. The record is on this channel. If you want the same starting point I used, the exit line calculator and the full ETF list, it's free, linked below. One decision, once a month.